Welcome everyone to our PANGEA Q1 2022 Investment Manager Update with Rawn Lakhan, who is the CEO and portfolio of Meadowbank Asset Management. Here we have one more person joining us, and we're just going to click on that join button. Hello and welcome, Jackie, to the call. We're just getting started. And Ron, this particular call is going to be an interesting one because over the years we've had a number of successes to celebrate, and I think we still have some of those successes to celebrate even now in 2022 as we see a curious state of affairs coming out of a pandemic, 2 years of a curious thing that none of us on this call have ever experienced, and having to navigate that into what some of the bigger investment banks in the planet are calling for us heading into a potential recession. What I'd like to do is invite you, Ron, to the call to give your opening remarks. I've got a few statements here and questions that I'd like to ask as we guide the conversation. For everyone that's joined us just recently, a reminder that in our Zoom platform, you do have the option to click on the chat button and ask your questions or leave your comments or invite Ron's thoughts as we have this discussion about where we see the equity markets now and into the coming quarters of 2022. Ron, welcome to the call. We're so very grateful to have your presence here on our PANGEA Investment Manager Update.
Thank you, Declan. How's everyone?
I think everyone is doing really well. Most folks are on mute and
oh geez, okay.
Ready to have this learning opportunity with you. So feel free to take it away and launch into your contribution, and I'll guide with any questions and commentary that pops up and things that I have on my desk. Over to you, Ron.
For sure, Declan. Thank you. Well, essentially, as Declan mentioned, the last quarter, in fact, in 2021, has been rather interesting in the equity markets. Surprisingly, the Canadian economy fared very well last year, having GDP growth of just over 6%. And that's primarily given, because things were opening up, markets themselves in restaurants and certain stores. And this was because of a lot of it with the COVID-related lockdowns. So Canadians generally responded quite well and came out pretty strong. The curveball that was tossed to us at the beginning of this year was the Ukrainian-Russian issues. And, with Russia invading Ukraine, that created a lot of problems. As President Putin puts it, essentially this is inflationary effects have spilled all over to the world right now. And most notably, we're seeing that in the price for gasoline, price of energy prices, food prices. All of that has increased, and most of that has been caused as a direct result of the Russian invasion of Ukraine. So as a portfolio manager, we now have to navigate, the impact of war in Europe, potential spillover to the rest of the world, primarily energy prices and food prices. Now, energy prices and food prices are very large components in how we measure inflation. We're seeing inflation now reaching new highs in Canada. The Bank of Canada basically has responded where they've increased interest rates. We're probably going to see interest rates increase again, in fact, a few more times before the year is out. All of that is to curb inflation. Now, that seems very grim. The positive, obviously, that's come out of this, that's given, the silver lining, I should say, has been Canadian employment numbers. Employment numbers are still rather strong. The consumer themselves during COVID, this is 2020, 2021, Canadians by and large saved a fair bit. So the household balance sheet looks fairly well. And the employment market has actually picked up. Now, one could argue, what type of jobs are out there? They're generally middle to lower quality type jobs, but Canadians obviously responded well, and employment opportunities are abundant. Now, obviously, that's very specific skill sets. Now, knowing all of this, and you have so many different uncertain factors, as a portfolio manager, we've obviously selected names. We did do one major rebalance the beginning of I would say mid Q1, where we added names that would benefit from this. We're very cautiously optimistic. All numbers point to the Canadian economy growing at about 4% this year. We've still stayed focused on financials. The banks themselves are one of, and TD is one of our largest holdings. One might ask, how does a bank respond to higher interest rates? I mean, obviously, you get to lend a little bit higher at higher rates. The folks that are on variable mortgages, they're the ones that will get hurt a little bit. But TD, by and large, has performed quite well. We added Nutrien to our portfolio. For those who don't know who Nutrien is, it's one of the largest fertilizer companies in the world. Where we see the value of Nutrien is there will be, potential food shortages going forward. If your diet includes a lot of grains, wheat, flour, or use a lot of oil, you would have already seen those the prices rise dramatically. Nutrien provides the fertilizers to the farmers. So Nutrien was a tactical play. It's a very strong company. It's definitely, if not number one, but number two largest fertilizer companies on this planet. It stands, head to head with Archer Daniels, Mosaic out of the US. We obviously acquired Nutrien given it has a very strong balance sheet. So the names that we picked up, and some of the US portfolios, you would see we acquired Berkshire Hathaway. That's Warren Buffett's company. It's the largest shareholder of Apple and also has a very healthy weighting in financials. And they're sitting on, billions of dollars of cash ready to spend. So what I'm really trying to get at, the thesis is picking strong companies with good balance sheets and that are still paying a nice dividend. Some of you will notice that we added Enbridge to our holdings. You're looking at a nice dividend of about 6%. What that really capitalizes on is the energy prices. But Enbridge, a lot of you might not know, it is the largest company providing energy that adheres to the ESG mandates. And it's the largest renewable energy company that trades on the TSX. Over $8 billion has been spent on green energy initiatives in the last 10 years. It doesn't sell natural gas. It has the pipelines and is also active in wind and solar. So we do adhere to ESG mandates, which is a new profile that's very pertinent in the current market environment. Now, I did say a lot by picking specific names, but the key to get from this is that we're navigating rather uncertain times. And if one were to ask, Ron, where do you see things? And Declan, I'm sorry for jumping, but at the end of the day, we essentially are picking names that can withstand inflationary pressures. We're picking names that are not going to go bankrupt. So you'll notice in all of your portfolios, consumer discretionary spending is next to nil. We have next to nil oil and gas exposure, given it's just too volatile for the portfolio. We missed out last year with oil and gas. It is a great holding, but a lot of the premium for oil, everybody anticipates oil to be in 110 to 120, but if you really take away the war premium, oils should be around $65 to $70. That's the volatility, and we've stayed away from that. On the US portfolios, we added NextEra Energy, which is really formerly Florida Power. So the bias has always been strong companies with a strong dividend, as we wait to go through this malaise. Events that have occurred this year and last quarter, we've never seen them. Nobody's ever seen a pandemic and tested it. Adding war, we're now moved into a world where globalization has I can't say it's dead, but it's definitely being tested. So back to you, Declan.
No, I appreciate the specifics that you went into. I think to paint the picture at a micro level and a portfolio allocation level. What I'd like to do for the next segment of our conversation, Ron, is just elevate it up to a strategic level in our conversation, so folks get a broad view, and they'll be able to tie that with some of the names and positions you've taken, for what reasons you've taken them, and we can of course invite questions and commentary throughout the conversation here with folks who've attended. Um, Goldman Sachs just recently published a paper with the headline, "Will the US go into recession?" That's the question in the opening headline of the article. And I'll read a bit of what they said here, and draw your commentary and your perspective on this so we can learn from you and your thinking and your team's thinking. It says, history suggests it's not easy to cool the labor market without causing GDP, gross domestic product, to slump. The US unemployment rate has never gone up by more than 0.35 percentage points on a 3-month average basis without the economy going into a recession, is what they say. Once the labor market has overshot full employment, the path to a soft landing becomes narrow, is what the economists at Goldman Sachs say. And they suggest that the historical patterns deserve some weight, and the overheated job market has caused a meaningful increase in the risk of recession. What these Goldman Sachs economists are projecting is, as a result of these things, the odds, according to their calculation, that there's a 50%, 15% chance of a recession in the next 12 months, and a 35, it increases significantly, a 35% chance of a recession in the next 24 months. As a portfolio manager thinking about these things, and I know they're on your radar, and I know you're talking to your people about them, how are we positioning for the next, let's call it 12 months, to manage this sort of a recessionary perspective? Are we more defensive? Whereabouts are you focusing?
To your point, Declan, and just for clarity, a recession is defined as 2 consecutive quarters of declining growth.
Correct.
Growth, that is. Now, I agree with Goldman Sachs. In fact, I would have put that number higher, especially on the US side.
Wow, on the projection, you mean?
On the projections.
Wow.
Now, the US themselves, and then not to bore you with data, but the US economy in the last 10 years, all they've been doing is printing money. The country is one of the most indebted countries on this planet, has one of the lowest actual dollars in reserve, but the American economy is still resilient, that it can grow faster, quicker, and it's probably one of the most dynamic economies on this planet. Now, that being said, Declan, to your question, and for all of you, essentially the names that we pick are names that I would like to say are recession proof. You would have all noticed in the last quarter, your portfolios fell a bit. Good and bad fall when there's uncertainty in the markets. And what I mean by that recession-proof names is that when selecting a name, I look at it this way, is that people in general need to eat. So if you need to eat, you're going to buy food. One of our top holdings is Metro. Metro's a grocery store chain. We had Loblaws about 2 years ago. We bought Metro. The primary reason for Metro is that you have to buy our groceries. It's been growing, and Metro doesn't have one shareholder. It's a widely held company. No one person controls more than 10% of Metro. Groceries, food. Now, somebody might say, what other names? On the US side, we own Walmart. Walmart's performed quite well. In the US, you can buy from a boat or diapers or milk at Walmart. Walmart has been the go-to. It's the largest retailer on this planet. And it's more or less very focused on trimming prices. They actually compress the margins of all of their suppliers to still give us a price, a lower price than most big box stores. So that is recession proof, in my opinion. In Canada, we own Couche-Tard. Someone might say, well, why do you own Couche-Tard? Couche-Tard owns Circle K. Everyone goes in to buy their gasoline. they get a car wash, they buy a bag of chips, and they like to play a lottery ticket. Simple business, but it's actually done well. Couche-Tard is the largest variety store operator in North America. Is it recession-proof? Well, we all need gasoline to drive and get to work, and we're all going to walk in and they get you for gasoline, and you're going to buy a bag of chips, and you're going to buy a drink or a pack of gum. Simple business. And in terms of barriers to entry, they're the largest. A newcomer just can't enter the market space and compete directly with Circle K. So another key point I just mentioned, barriers to entry. Couche-Tard cannot be recreated that quickly. Now, I mentioned earlier about Enbridge. Well, at the end of the day, we're heading into summer, but Enbridge has the pipelines, the infrastructure, as we get colder for natural gas to be shipped to all of our homes. All of us on this call right now, more than likely have Enbridge shipping natural gas to our homes. And simple business, it's a utility. It pays a nice 6% dividend, and it's probably one of the highest dividend yields on the TSX. And it is the most traded stock on the TSX. So you've got liquidity as well. So Declan, to your point, I can go through with more names, but the names that have been selected have always had that focus, is barriers to entry. And I'd like to say that we're picking names that we believe will benefit if the market pulls back. Now, to the Goldman article, if there is a recession, there highly will be. And we don't see the recession happening this year. We see a recession of a pullback of 2 negative growth quarters early next year in 2023, given that there's a fair bit of stimulus still running into the markets right now, and it takes a few quarters for it to catch up.
I appreciate that. And even in the context of when we hear, generally, there's a psychological reaction to hearing the word recession or the word depression in the media headlines or in the news. But, if you apply your definition to consecutive declining quarters of GDP, in the context of an overheated environment, that could probably be a positive thing.
You're right. And I mean, the federal, really and truly, the government has 2 sets of policies that they can play with: fiscal policies and monetary policies. And all of that trickled back down to the stock market. Now, fiscal policies we've seen, we're in an election year, and at the provincial level right now, everybody's going to give all of the lovely handouts. At the end of the day, somebody has to pay for it, which are all taxpayers. But they're doing that to stimulate the markets. We saw some new rules being imposed on housing. The housing market has been rather overheated. Now, the GTA is in a different situation relative to the entire Canada. We actually have demographics supporting that. I'm not saying or prescribe to the fact that an average home should be $1 million, but it's simply the laws of demand and supply. So they're trying to curtail speculation. And we've seen that with the last budget. On the monetary side, the only thing Canada or the US has at their disposal is interest rates. Now, to your point, Declan, they're going to, this inflation that's been created has been supply side driven. Somebody might say, well, what does that mean? Supply side driven is, although North Americans were looking at it saying that COVID has come to an end, it hasn't. China still has lockdowns. There are still supply chain restrictions. Only on Friday, I spoke to a friend. They can't move between Beijing and Shanghai. They're still in lockdown. If you want to buy a new car, more than likely, if you walk into that lot, you'll go buy the car, but they'll give it to you in 2 months. There are supply chain issues where there's shortages of certain products, right? So all of that created the inflation where prices went up on the supply side. But the only tool the government has is let's increase interest rates to reduce the ability of consumers wanting to buy that new car or go buy that new house, or they'll more likely hang on to their money a little bit longer. And at that point, then you'll see prices coming back down.
I appreciate that, Ron. I've got some questions that are coming in the chat here, which I'll ask you in a moment. But before I get to that, those questions, I wanted to transition to this part of the thinking in our conversation with a headline from the Wall Street Journal. This is as of May 3rd, yesterday. The headline from the Wall Street Journal reads, "Stocks and bonds are falling in lockstep at a pace unseen in decades." That's the headline. Now, for us on this call, I want us to unpack that thinking to really get beyond the headline. The article goes on to say the following, and I'll then pause after sharing this to get your commentary, Ron, on this. The article says, bonds have long been viewed as a hedge against expected swings in stocks. That hedge, however, has evaporated this year. Stocks and bonds are falling in tandem at a pace not seen in decades, leaving investors with few places to hide from market volatility. Just this Monday, the S&P 500 was down 13% for 2022, and the Bloomberg U.S. Aggregate Bond Index, largely U.S. Treasuries, highly rated corporate bonds and mortgage-backed securities, was off by 10%. And that puts them on track for their biggest simultaneous drop in the Dow Jones market data going back to 1976. That's the year I was born. The only other time in both indices dropped for the year in that sort of amount was back in 1994, when the bond index declined 2.9% and the S&P fell 1.5%. The last comment I want to make here is that the S&P just finished its worst month since March 2020, while many technology stocks have been harder hit. The NASDAQ Composite Index is down almost 20% this year, and shares of many of these tech heavyweights that have driven the market higher in recent years, which I think is important for us to be aware, these are now sitting on double-digit percentage losses. And part of the reason I wanted to raise that conversation with you is that one of the questions we have in the chat is connected to technology stocks. But before we get to those questions, Ron, I'd love to welcome your thoughts and commentary on that Wall Street Journal article.
Thank you, Declan. I'm going to try to dissect it in the pieces that I can recollect. Now, just touching on the technology and where the stock markets are, and I'll tie that back into the stock markets and the bond markets both falling in tandem. Most of technology, and if you follow the NASDAQ index, has been driven by an acronym which really represents a few names called FANG. And FANG, it really stands for Facebook, Apple, Netflix, and Google. Those have been the biggest part and the biggest weightings in the index. And a company like Netflix, for example, it's a large component. People are going back to work. They're not watching movies as much as they did during COVID. The subscriptions have fallen. Facebook and Google both have antitrust issues. That's taking that hit with the technology space, given they're the largest components of the overall index. Now, that being said, what we've seen is investors are looking and they're moving back to value-oriented investing versus growth. And the primary difference is technology names tend to be more growth names, where these companies are not paying a dividend. The companies are going to grow. A lot of their earnings are put right back into the company so that they can expand their business model. In this type of market, and I'll tie it in what's happening, in this type of market, investors are going back value, realizing I have to go into safe harbor. And safe harbor being, I'm going to go back with a boring utility company or bank that's going to pay me 5% a year, as opposed to a technology company where I was doing 30% a year. And investors have been flocking back to value-oriented stocks. Obviously, some technology names like Apple's and Microsoft's, they're here to stay. They're very large, but their peers that are still in that growth phase have all fallen. Tying this all back now to why would you see bond markets and equity markets both falling at the same time?
Mm.
That's investor sentiments. Number one, on the fixed income side, that's mathematics. Given when you have higher interest rates, or you anticipate higher interest rates, bond prices fall.
Mm-hmm.
So that's number one. Number two, well, why would equity fall? Well, equity is falling because the names that are exposed to higher input costs. Now, like I said earlier, oil prices have gone up. A lot of things that involve plastics or involve, any variation of using oil as an input, they've all risen. Their costs have gone up. For example, Coca-Cola, moving their concentrate, let's say from Asia to Europe, a container cost about $1,500 to move a container. Today, and this is a 40-foot container, today that price is about $8,000. That affects their bottom line because you're seeing that being translated where their input costs are going up. With Indonesia announcing, for example, restricting exports of palm oil and certain oils that are edible. The biggest company that's going to get affected by that is Nestle. You might say, well, why? Well, Nestle produces so many food products and chocolate bars. It's that oil is in all of those products we eat.
Mm-hmm.
So investors are now seeing those larger companies, their margins are being compressed because their input costs have gone up. So you're seeing stocks fall out. Now, the one that worries me the most as a portfolio manager, but where we've insulated the portfolio such that we pick names to prevent this. Obviously, we try our best of picking the best quality names. Is the one that we should be more fearful of is if the consumer rolls over. What that means is simply we all make a certain amount of money and call it $100. If now all of a sudden, and out of that $100, for those who have mortgages, half of it goes towards your house. Then you have to eat. And then you have normal entertainment expenses. The first things that tend to get restricted, if all of a sudden you're spending more now on gasoline, you're spending more now on food, are going to be discretionary spending. You might not go to the movies. You might not go to the restaurants. We've picked our names for eliminating companies that are involved in that. But you need to eat and you need a roof over your head. So that's how we've selected names. Now, that increase in interest rates for the folks that are on variable mortgages, well, if they're running paycheck to paycheck, those are the ones that will be affected the most. Now, like I said earlier, with a strong job market, one would anticipate with enough stimulus in the market, it will rebound. But to the Goldman article, we're not out of the woods yet. We will see some choppy quarters ahead. So I hope I haven't confused you, but to tying it all in is you're seeing that flight to quality right now, and the markets are adjusting where that safe place to be is going to be in the boring utility or the boring company that's paying us a nice healthy dividend. And I hate to put it this way because I believe one of the news reporters, when Citibank had problems, too big to fail, but really and truly that's where you have to go. In larger names that can withstand the volatility that's ahead of us.
I appreciate where you're going with the thinking, Ron. The question that was actually posed here in our chat, you addressed to some degree, you addressed Apple. There's another big name in the chat, and I'll ask the question as it was presented, and you can choose to respond however you feel is best. The question says, how do tech companies like Apple and Disney perform in this kind of environment? I know you addressed it to some degree, but I wanted to ask it for the sake of respecting the question and the person who asked it so that you can comment on any further things you thought was necessary.
Disney essentially recovered well when we were coming out, when it looked as if the markets were opening up during COVID. It obviously didn't do very well during COVID, given the theme parks were shut down. But Disney activated their Disney Plus online ability or streaming services, which was a direct competitor to Netflix. The silver lining with Disney is Disney Plus, given that they own their content, they own their own content. And it's definitely a serious competitor to Amazon and Netflix. Disney actually has gone out and bought and owns its own content, i.e. studios, Star Wars, Star Trek, all of these things. Disney's gone out, not Star Trek, Star Wars. Disney's gone out to acquire that. You're seeing the other competitors like Netflix and like Amazon going out to try to buy content. For example, you can, when we get off this call, look at your TV. You probably have 300 channels, but still can't find something to watch, given that there's so many channels and they're all dying for content. So to bring it back now, where's Disney? Disney will not perform as well relative to other names, going back to safety, given a lot of Disney's revenues are attributed to discretionary spending. Now, if you're having a hard time, I doubt you will be going to a theme park or look to going to a cruise. That being said, though, if there is signs of, given the consumers actually have some extra cash, and COVID, if it were to be, let's say, under control, or one would say it is, but I believe it's the media that's making us believe it is, but it isn't. There is a lot of pent-up demand for leisure. A lot of people need to go on vacations. Disney, for me, as a pointed question, is a hold. I prefer an Apple more so, given that Apple has very, very high margins on their product. Apple is in your home in every capacity, from their music to their downloads, and all their new iterations of their products. The only issue I see with Apple is supply chain, is getting their products out of Taiwan. Most of Apple's products are produced by Foxconn and their competitors. One of their phones cost about $20. And we buy it for $500 to $800. And depending on what you own, some of them are in the thousands of dollars. They have great margins. So Apple's is diversifying its revenues as well. So Apple's is definitely my pick over a Disney in the current environment.
Yeah, I appreciate you saying that, and of course, you can appreciate the question was asked by folks who may have vested interest in those names. So as we shift into the latter part of this conversation, and I want to express my appreciation for you sharing your thoughts on what we are experiencing, and would love to look to the future now in the coming quarters. And I'd like to share a couple of personal experiences. You mentioned the world opening back up. I had some time where I took about 9 days and I visited 4 provinces and 12 destinations in the East Coast just a few weeks ago. And even just this past weekend, I was in Niagara. And what I observed just in that short space of time was just how many people are teeming outside in these environments again. It doesn't feel like we're in a lockdown anymore, and some places are eliminating their mask mandates. And I make these statements from personal observations to support your statement about pent-up demand. People have money that they haven't spent in the last 2 years, and it wants to get out. It wants to go do something in the way of creating a leisure and enjoying life once again. And even restaurants in Niagara Falls itself, I was surprised to see lineups outside restaurants in Niagara Falls, people waiting to get in. So there are that many people still wanting to get in, even at this stage in the cycle. And I don't think we're even to the point where we're experiencing the crest of the wave, if you will, of people coming back out to spend pent-up demand and money that's pent up. I wanted to share that as I transition into this part of the conversation. The name Jerome Powell from the US, and this is some good news coming off today when the markets closed today. This is a live stock market update as of this afternoon. Stocks jump after Powell pushes back on bigger rate hikes after the half-point increase. U.S. stocks turned higher this Wednesday, today, with investors considering the Federal Reserve's latest monetary policy decision against the backdrop of elevated inflation and a still tight U.S. labor market. The S&P, Dow, and NASDAQ each rose and extended gains Wednesday afternoon today after the Fed Chair Jerome Powell suggested that future, and get this, future 75 basis point interest rate hikes were not currently in discussion among central bank officials. They conclude with some data saying that the benchmark 10-year Treasury yield rose to just below 3%, or near its highest level since 2018. So we're seeing some meaningful thinking here from folks that are responsible for the monetary policy changes that will impact the stock market and other areas of the economy. They're being mindful, and I think that's encouraging news as we look at for next steps here. There's another question that came out here for someone who's actually based in Florida. It's in our chat here. It says, as for Disney, evidently Disney's making a bit of a splash in the conversation. How do you anticipate the recent legislation in Orlando location affecting the stock? I don't know if now's the right time to comment on it, but if you want to share just a few thoughts, we can definitely address that offline. But I'll leave it to you, Ron, to decide how you want to address that question about Disney and the recent legislation changes in Orlando and it's affecting the stock.
Why don't we discuss that on offline, Declan? To put it bluntly, and we can discuss it more in depth. I don't see any issues with that affecting the stock itself. It's a hiccup for a large firm like Disney. To your point, and just to temper my views on the firm itself, to your statement in Niagara Falls, Disney has resorted to having reservations. There's so many people that want to enter the park.
Yeah, indeed.
There's so many people that want to enter the park, and a lot of kids, they haven't gone anywhere in the last 2 years, families. So there is a lot of pent up demand, and they will do that. See, there's a concept called the Duesenberry concept in economics. And all it simply means is when people are accustomed to certain things and certain spending patterns, they will continue to do so, even if their income reduces. Yeah. What they will then do is just take more credit. The American consumer has no issue taking more credit. Mm-hmm. So at the end of the day, sometimes credit's a bad thing, but for Americans in general, and we've seen it historically, it's actually worked in their favor. So, to put it bluntly, the stock itself has a lot of legs, but we've positioned the portfolios just to insulate, not in the next quarter. We've insulated for the end of the year, given that there will be some negativity and some fallout. So I don't want to change the topic a little bit, but I'm not more worried about the consumer rolling over. I'm more worried about, the implications of the war with Russia and Ukraine. Perhaps President Trump started this first with destabilizing the global markets and the globalization itself, which was more or less a concept created after World War II. But you now have countries that don't really necessarily want to trade any longer, or they have more protectionist measures. All that is and will translate to us is we will start to have higher prices, and the higher prices, more or less for certain items, will be here to stay.
Wow, that's a profound statement, and folks are seeing it showing up in their grocery bill. I know I am, and even at the gas pumps. In driving out to Niagara Falls, all the readers at the gas pumps were reading it, all over $2 for every type of gas, every quality level of gas. It was a bit of a shock. I actually took a picture of it. And the last thing I wanted to share about how personal experiences are impacting the broader or reflecting the broader changes. You talked about capacity and lineups at Disney, for example. My own son and I, after 2 years, we finally went back into the movie theaters. And what the movie theaters have done is that they have to do safe seating, which is staggered. So there are only 4 families in the entire theater. And that, like you said, folks want to get back out there and want to start spending money. So my last conversation here, As I open it up to the floor for any comments or feedback or questions, I just want to remind folks that you can click on the chat button to ask your questions. Would love for you to share your comments or questions, and I'll moderate. I'll definitely share them back with Ron as we look to conclude this call with his taking his time to be generous with us this evening. As we look to the coming quarters, Ron, I'd love for you to give our investors and our clients on this call just some either cautionary notes, but also some words of positivity that we could look forward to. We'd love to hear your thoughts as you look out with your team for the coming 2 quarters and what you see.
There, in all of this, and this entire call was never meant to be negative, but be more informative. That our team scours for value. Valuations have been very key when selecting stocks. Our universe, there's so many names. I mean, and all of this conversation excludes our hedge portfolios for those who have the hedge portfolios. But nevertheless, the positive to this is the governments themselves, and we should be thankful being in North America, or at least in the developed country, is that Canada, I can't say, Prime Minister Trudeau has done everything correctly. I have no political affiliations, but I believe the world has changed itself, and our team will definitely select, companies that, Warren Buffett probably put it best, companies that have really high barriers to entry and have predictable revenues. That's not to say we're not going to take out the growth. These are all tactical changes that we've already made to the portfolios. And those that have watched their portfolios, on a quarterly basis will note the names that we've selected are very solid names. And all of this negativity, they haven't fallen by much. And, unless, depending on the portfolio you're in, they've held their ground. And, the positive is we will come out of this. It's not all going to be doom and gloom. If there isn't, even if there is a recession in the latter part of this year, that rebound will come as the consumer starts to readjust, as interest rates will start to more or less 2024, more or less stop and potentially started to go back down. So we will see higher interest rates, but that's fine. You're going to see the higher interest rates, but that's only going to only affect those that are highly levered. And, I know all of you are astute investors and you don't have that leverage. It will affect folks, but at the end of the day, the markets have been quite resilient. And I'm thankful we're in Canada. Just as a factoid, Canadians saved over $400 million in the last 2 years. And that's because they did not go to restaurants, they did not spend money on gas, and they worked from home. We took that money and paid down our mortgages and our debt. That's a very, very good thing. The household balance sheet in Canada is much better than the American balance sheet. And that's what's going to pull us out of this malaise. The only thing we don't control is what Mr. Putin does in Europe. It could escalate to something larger. At this point, we hope that it doesn't. But you will see now a shifting of power where the world will be polarized. You're going to see, the East versus the West. That started again. So if somebody said the Cold War starts all over again, it probably has. But, at the end of the day, the firms, again, that we've invested in, they don't have that much Russian exposure. And Russia was never really that large. It's really Europe's largest gas station. So at the positive is you're in good hands. And our company, our firm, our team will change names as the markets evolve. We're in for a choppy next couple of quarters, but not to worry. You're well insulated with good quality names.
Are you saying then, Ron, that the choppy quarters represent holding opportunities or buying opportunities, or is it a blend of both?
It'll be both. The names are very seldom do we shift around with names, but if we have substantial gains in certain stocks, we will unload them and pick up names that have been hurt the most. If you look at an example in 2021, the end part of 2020, though everybody thought the world was coming to an end, every Canadian bank fell to $50, $60. By Q1, the markets had doubled back.
Indeed.
Those are opportunities right there. Can we spot them? If we see that opportunity arising, we'll definitely, pounce on such an opportunity where you're seeing good quality names. And, Declan, I can answer that Disney question just to put everybody's mind at rest. It's a politician that has a view that, Disney has an opinion on a certain community of folks, whether it's right or wrong. And, Disney losing its self-governing ability does have some ramifications. But this is a company that's entrenched in Florida for the last 50 years. I'm pretty sure they'll kiss and make up, and they'll come up with a solution. So I don't see that affecting the stock at all.
Long term, indeed. Ron, listen, I want to say thanks very much for your time. I know we've got a few minutes over your committed time, and you've taken some time away from your family to be with us this evening. A deep word of gratitude from PANGEA and our clients to you and your team for all the remarkable work that you continue to do. I know that there are folks on this call with individual portfolios that have questions about some specific holdings, but we'll set up those individual meetings in the weeks to come so we can get those ideas addressed. What I would like to do is just give the folks on the call a final moment if they wanted to just drop a thought or question or a comment into the chat box, and I can definitely share those back while we look to conclude this meeting. But thank you, Ron, for the final comments, the outlook, given the uncertainty that we're dealing with and what I would describe as heading into times that are definitely unusual. As I've mentioned off the top of the call, none of us alive today have gone through a pandemic and what comes out after a pandemic. So we're all experiencing it together, and I appreciate having your team's expertise and your seasoned approach to being conservative, because you're looking at names that are big enough and durable enough is the word that I'm hearing a lot in conversation, durable enough to help us navigate through the next few quarters of this uncertainty. So thank you very much for that time and your expertise.
You're welcome, Declan.
All right, everyone. With that, I see no more comments or questions in the chat box. So we're going to look to lock off this call, and I've archived it. So I'll send out a copy of it to those of you who want to hear it again, and to those clients who couldn't make it on our call this afternoon. Have a great evening, everyone. Bye-bye. Thank you for joining us for this PANGEA Investment Manager Update. Bye-bye for now.